So today, I think it would be useful to think a bit more systematically about what yield curves do, how they tend to behave over time. Then, once we've learned the basic facts of how it is that yield curves tend to behave over time, the second thing we can do is to use economic theory to try and explain this behavior, to figure out what does economics tell us is the reason why yield curves do what they do. Finally, once we have an economic theory understanding of why it is that yield curves do what they do, we'll be able to observe yield curves and see what it is that we might learn. So if you think about it, consider a long-term bond like, let's say, a 5-year bond. Presumably, this has to do, if you buy a 5-year bond, you're lending someone money that's not going to be paid back for 5 years. And so the interest rate that you charge or the interest rate that you observe in the market on a 5-year bond probably tells you something about what people expect to occur over the next 5 years. So that means that once we understand what kind of information is encoded in interest rates and in yield curves, when we see a yield curve, we'll be able to figure out something about the forecasts that the people that buy and sell these bonds must be making about the economy over that time frame. Okay, so that's what I hope to do today. So to do that, I think the first thing that's worth doing is just to spend some time looking at some yield curves to see what are the, let's say, stylized facts. What are the common features that we can see when we spend time looking at yield curves? So this sheet that I have here is called the yield curve worksheet, and you can find it yourself if you wish under exams. It's written as a sort of series of problems, but it also just contains a lot of information about yield curves. So let's start by just looking at it. If we have time later, probably not today, we could go into breakout rooms and work on some of these problems, but I think next week is probably better for that if we have time. So what do we have here? Each line here is a yield curve from a different time. So let's say this 2004 yield curve that I'm moving the cursor over, that is telling us on a particular day, let's say February 9th, 2004, what were the interest rates on the different, on the bonds of different maturities. Then this line is the same thing, except that it's for, let's say, February 9th in 2005. What were the interest rates on the bonds of different maturities trading at that time? And then this is 2006. And the dark one is 2007. So what can we observe? What features jump out from here at us? Does anything leap out at you in terms of stylized facts? So let me roll down so you can look at a few more. This is actually what happens next. This is 2006. This is 2007. This is 2008, the whole curve. 2009, and this dark one is 2010. Sophia points out that They're all either upward sloping or flattish. That's right. I guess the one for 2007 kind of slopes down for a little bit. It would slope down if it weren't for the last couple of interest rates. But yeah, they usually slope up, although not always. Remember we discussed before that occasionally you could have an inverted yield curve, which is when it slopes down. Even then, when the inverted yield curve appears, it's not going to slope down very sharply. So that's exactly right. What else can we observe from here? You see, Marshall says longer maturity is associated with a higher interest rate. That's right, usually. So these rates are usually in this figure and in the one before higher than the ones over on the left. Another thing that you might notice is that these long-term rates don't actually move around much either, right? They seem to be fairly stable, whereas the ones over here, on the left-hand side, they seem to move up and down. Here we have 2007, 2006, 7, 8, 9, 10. The short-term rates move up and then down again. And here, 2004, 2005, 2006, they're moving up. So actually, one thing that Sophia, an implication perhaps of what Sophia said, which is they usually slope up or kind of flat, and then they kind of keep going up and down again, right? It means that the rates don't seem to have any trends. It's not like short-term rates always go up or always go down. They seem to rather have something that in statistics you would call mean reversion, right? There's some average rate. Let's pick the 1-year bond, for example. There's some average rate, like let's say 3%, just to pick a number out of a hat, that the 1-year bond tends to be. And then sometimes it's higher, sometimes it's lower, but sooner or later it's going to come back and it's not going to deviate too far from there. So that's another thing we could observe here. As a result, another observation might be that when the yield curve is steep, that's when short-term rates on this end are unusually low. And similarly, when it's flat or downward sloping, it's the opposite, right? The interest rates, the short-term rates are unusually high. That's another observation. And I guess another thing that we could observe, which is kind of implicit in the fact that we're able to talk about yield curves at all, is that the whole thing tends to move up and down together, right? When interest rates rise, it's the short runs and the long runs as well. Maybe the long run rates don't move as much, excuse me, but the whole curve tends to move up and down together, with the short-term end doing more of the moving than the other end, of course. So why don't we, so I think that's clear here and here. Together there we have more than 5 years of yield curves. So in a second, I'm just going to write down all those facts. And what we'll do next is explain, well, think about how economic theory might help us explain these observations. Before we do that, there's one thing that I want to show you, which is that notice that these yield curves were all from, well, from various years, but the last year for which I showed you a yield curve was 2010, right? Now it turns out that since 2010, yield curves have been doing something a bit unusual. So I'm going to ignore it for now, see how much we can learn by looking at historical yield curves first, and then probably next week we'll have a look and see if we can figure out why might the yield curves nowadays look a bit weird. So here is what I'm talking about. This orange curve, you should be seeing two curves, a blue and an orange. The orange one is the yield curve from yesterday in 2016, so February 9th. And this is the yield curve from yesterday, 2021. You see anything unusual? I mean, I guess I see two things that probably are worth underlining compared to the other ones that we looked at. One is that the interest rates are really, really low, right? They're like zero. And not only are they zero, they're zero basically even including, well, the 1-year bond is basically zero. The 2-year bond is slightly higher. You have to go to 7 years or more to even get up to 1%. Another thing that stands out to me from the yield curves nowadays is that, remember before we had that the long-term rates don't move very much? It's the short-term rates that move around most. Here we have that the long-term rates have moved as well. So we'll set that aside for now, but at some point we'll come back to it and see, try and figure out, based on what we know about yield curves, can we explain why the yield curve has been behaving strangely since 2010? Any questions, comments? All right. If there's nothing right now, then let's go to the whiteboard and write down systematically some facts about yield curves. Here's my ruler. One, as you observe, they usually slope up, but not always. And associated with that, you may recall, they tend to slope down. When they slope down, it tends to be a harbinger of a forthcoming recession. So we'll have to wonder a bit, why is that the case? So not always. 3, when it slopes up, the yield curve slopes up, which is the same thing as Marshall was saying, that the long-term interest rates are higher. When it slopes up, this tends to be when the short-term rates are unusually low. And similarly, when it's flat or slopes down, it's when short-term interest rates are unusually high. That's the converse. 4, we noticed that long-term rates don't move around much, or at least they don't move around much before 2008. We'll revisit what might have been going on since then at some point. And last but not least, the curve tends to move up and down as one. In other words, the interest rates tend to all rise or all fall together, even if most of the action is on the short-term interest rates. So next, this is how economic science usually proceeds. We're going to make some simplifying assumptions to try and make sure that we have a clear, simple logic to try and think about why might yield curves display these features. Now, the simplifying assumption that's going to give us a lot of mileage here is the following. Remember that we were discussing recently that in general, people tend to be risk averse, right? If a person is presented with the option of getting $1,000 for sure or getting $1,000, sorry, if someone is given the option of getting $1,000 for sure or $2,000, but only if I flip a coin and it lands on heads, people generally prefer the sure thing to the lottery, basically, where the coin flip, where the expected value is the same as the sure thing. We call that risk aversion. And however, for this exercise, we're going to ignore it and see how far we can get. So we're going to assume people are risk neutral. What does that mean? It means they don't care about risk. It means that they only care about expected values. So a risk neutral person or a risk neutral entity would not care between the $1,000 for sure and $2,000 if you flip a coin. For a risk neutral entity, it's essentially the same thing. So one way to sum that up is that people only care about expected profits. There. Now, we're going to think about bonds with different maturities. So I guess the easiest ones to think about are to compare the 1-year and the 2-year bonds. So let's think about the 2-year bond, right? That's the simplest long-term bond that we could have. 2. Now, what happens with a long-term bond? Let's ask the following question. If I borrow for 2 years, then for each dollar that I get, how much do I have to pay in 2 years? To see that, consider that we know that this is the relationship between the interest rate. Actually, I have an idea. That's a relationship between the interest rate on the 2-year bond and P and F, right? So for the sake of notation, remember this is a 2-year bond. So to distinguish this interest rate from all other interest rates, I'm going to write a little 2 here, okay? So I sub 2 means the interest rate of the 2-year bond. That is what links the principal, the amount that I have to pay back in the future, and the interest rate, correct? So now, if I set P equals to 1, what it's telling me is how much do I have to pay for each dollar that I borrow. So if I set that equals to 1, then F becomes how much I have to pay per dollar. So let's multiply both sides by I plus, well, by this denominator here. Of course, we end up with this being the amount that I have to pay later. So if I borrow $1 now, I have to pay back this, 1 plus I sub 2 squared in 2 years. What's the point of going through all of this? The point of going through all of this is that if I'm contemplating borrowing for 2 years, I have an alternative way of doing it. What is the alternative way of doing it? The alternative way of doing it is to borrow for 1 year, and then at the end of that year, borrow again, right? So I borrow $1 now. At the end of 1 year, I have to pay back whatever interest there was. Instead of doing that, I pay back that interest by borrowing for another year, and then at the end, that's what I have to pay back. So I could borrow for 2 years, or I could borrow for 1 year twice in sequence. So let's think about what I have to pay under that alternative. An alternative which is that I borrow for 1 year interest rates. Well, it would be I sub 1, right? It's a 1 year bond or 1 year loan. And then borrow again to pay off the first loan. Now, I guess for 1 year. So in the first year, I would pay I1, whatever the yield to maturity is for a 1 year bond or 1 year loan right now. But if I'm going to borrow again next year, I don't yet know what the 1 year interest rate is going to be. But I probably have a forecast. So let's call the interest rate, the 1 year, the 1 year bond that the 1 year rate that I expect to be around next year, I can just call it, I guess, I sub 1 next year. And then we just have to keep in mind that that's a forecast. It's some expected interest rate. We don't actually know what it is yet. So now the question is, what do I get if I do that? Or rather, what is the cost of trying to borrow in that way? Well, if I borrow $1 for 1 year, at the end of the year, I have to pay back this, correct? Now I'm paying off that loan by borrowing yet again. So for each of those dollars, I have to pay 1 plus I 1 next year, and Y for next year. Right? So I'm borrowing $1 and I have to pay back that in 1 year, but my objective is not to pay things back for 2 years. So then I borrow again, and for each of these dollars, I have to pay this. So the total I have to pay for each dollar I borrowed in the first place is the product here. Finally, I mean, all this is going to be true regardless of whether or not you're risk neutral. The key thing here is that if you're risk neutral, then these two, or rather if everyone is risk neutral in this economy, then these two have to be the same. Because of the usual no arbitrage argument. If everyone is risk neutral, then both the buyers and the sellers in these bond markets would perceive this as being the exact same thing as this, if they're risk neutral. So that tells us that this equality must hold. Now, if we believe this equality must hold, that's going to actually give us something quite powerful. Which is the following. I'm going to write that equation over here. It was, again, 1 plus I1 times 1 plus I1 next year equals this. What I'm going to do is I'm going to do some operations here that hopefully is going to end up giving us something that's much more intuitive than this probably is. To do that, let's expand this. So the left-hand side, it becomes 1 times I sub 1 time plus I sub 1 and y plus the products I1, and y, which again may or may not be the same as the first one. And that equals, let's expand this. It's 1 plus 2I sub 2 plus I sub 2 squared. Great. What can we do now? Well, subtract 1 from both sides. That disappears, that disappears. Then I want to subtract I sub 2 squared from both sides. To do that, let me move this over. So I subtract I sub 2 squared from both sides. And now I divide everything by 2. And what are we going to get? We will get, on this side, we'll only have I sub 2. And on this side, we'll have left over that, which is I sub 1 plus I sub 1 next year, divided by 2. Now that looks intuitive, interesting, and maybe powerful. It's saying that the interest rate on the 2-year bond is nothing more than the average of the 1-year interest rates over the next 2 years. Now, it doesn't quite equal that because there is this other term here, right? I1 times I1 and y minus I2 squared over 2. But we're going to ignore this. Why? Because in general, it's going to be close to 0. So I'm not sure if we have time to go through that right now, but I'm going to put a little problem about that in the yield curve worksheet when class is over, so that you can have a look and verify that that term is going to be minuscule. So what we have then is a, I guess you could write it this way if you want, is that the 2-year the interest rate on a 2-year bond is very close to or equal, in general we'll just say equal, to the average of the short-term rates. And yes, you can generalize. If I sub M is the interest rate on a bond of maturity M, whatever that is, that is going to be very close to the average expected short-term rates until M. So I guess, or until maturity. Right? So, okay, the 1-year bond is just the 1-year bond. The 2-year bond, according to this, would be the average of the 1-year bond now and the expected 1-year bond in 1 year. A 3-year bond would be the average of the 1-year bond, the 1-year bond in 1 year. I guess I should say the interest rate on a 3-year bond would be the average of the 1-year bond now, the 1-year bond in 1 year, and the 1-year bond, the 1-year interest rate in 2 years. So I've been trying to avoid mathematical notation, but in case it helps some of you understand how we're doing this, let's say today or this year is date or time t. Let I of M at t be the interest rate of a bond with maturity M at date t, which is today. Then the way to write this out would be that the interest rate of the bond of maturity M today should equal, well, the average of the short-term rates until maturity. So that's IM1, that's the short-term rate now, plus I think I made a mistake, sorry. So I is the interest rate today on a bond of maturity M, and that should equal the 1-year bond today, that's better, the 1-year bond that we expect tomorrow, so that's date t plus 1, or next year rather. Let me put an E there so we know it's expected. And then the 1-year bond the year after that, all the way to the 1-year bond when the thing matures. All divided by, well, it's an average, so they're going to be M of these. So this is just an equation that's trying to spell out what this means. Okay? Any questions or comments? Yes, let's see. Marshall, yes.
What does the E superscript represent?
It just represents the fact that since these are the 1-year, let me go back to here. So remember, this is the 1-year rate now, and this is the 1-year rate next year. Of course, next year hasn't happened yet, so the E represents that this is your forecast. This is what you expect the interest rate to be. Same here. This one is the 1-year rate in 2 years that you currently expect. So that's why all of these have this little e, just to remind us that these are interest rates that will materialize in the future. There's no way of us knowing right now what their values will be, but we should still have a forecast of them, right? Based on whatever information we have that we think feeds into or affects interest rates. Okay? Let's see. Great. So, what we can do now is go back to our previous slide and see, does this, so now we've come up with a theoretical conclusion for how it is that the different interest rates, the rates of different maturities might be linked or might be explained. We have that the interest rate on, the interest rate on a bond of maturity M should equal the average expected interest rates sorry about that, interest rates until M. Now we'll see, does this account for these facts that we came up with at the beginning? Let's see. Let's start from the bottom. Does this explain why, or is this consistent with, I guess maybe that's better, is this consistent with the fact that the yield curve tends to move up and down as one? Well, it is, right? You have, if M is 1, according to this, well, M is 1, so I of the first year rate is just some number. But if M is 2, remember, the 2-year bond rate, according to our theory here, is the average of the 1-year bond and what we expect next year to do. So, of course, you might expect those two things to often move together, since the second one is affected directly in this equation by the first one. So the first one rises, it's going to pull up the second one. The 30-year bond, same thing. It is the average of the 1-year bond, so it includes that. The 2-year bond, sorry, the 1-year interest rates next year, which is also something that comes into play in the 2-year bond. And then the 1-year interest rate that's expected in 2 years. So again, the 3-year bond includes in its interest rate determination the same factors that come into play, or at least some of them, in the 2-year bond and in the 1-year bond. So this is consistent with the curve tending to move together as one, because each bond of maturity M includes as its inputs things that came in affected the bonds of maturity M-1, M-2, and so on. So that works. What about 4? Long-term interest rates tend not to move very much. Well, remember that we observed that the short-term rates tend to move up and down in some range, right? What I referred to earlier as mean reversion. You never go too far away. They may deviate from what their long-term average is, but eventually it will go back. Well, if you couple that with our theory, that actually explains this. Because what is it saying? It's saying that things may change nowadays, but eventually we would expect reasonably the interest rates to kind of go back to their mean and not generally to deviate too far from it. That means that the expected interest rates, once you start going out far enough, don't move much. And they're all going to be, well, around the average. So that means your long-term interest rates shouldn't move that much. So that works. How about 3? When the yield curve slopes up, short-term rates are low. I guess that makes sense. Or rather, when it slopes up steeply, maybe is what I should have written there. That makes sense because, again, if your interest rates are unusually low, what do we expect? We expect them to rise sooner or later. And if they're rising, then of course that means that the expected interest rates in the future are larger and larger numbers. So that makes you have a steep yield curve. Next, does this explain why the yield curve isn't always sloping up? Well, yeah, right? The interest rates eventually revert to their long-term average. And so if the interest rates are low, you would expect it to return to the long-run average, giving you a steep yield curve. Conversely, if the interest rates were super high, you would expect the interest rates to decline, right? So then you could have a downward sloping curve, or if interest rates were expected not to move around much, then you might have a flat one, according to this theory. But here we have a problem. According to this theory, interest rates on long-term bonds equal the average interest rate you expect over that time frame, right? So according to this theory, if a yield curve is sloping upwards, it means that you must expect interest rates to rise, because it means that the expected interest rate tomorrow must be larger than the one today. And of course, we were just discussing that it's not that, so that would, for that to hold, it would require interest rates to usually increase over time, and we know that they don't, right? We were just discussing that interest rates tend to move in some range, they don't increase over time. So that means that our theory here must be incomplete. So we were able to explain a lot of these things, but not the most salient one, I guess, which is that usually yield curves slope up. So we're going to have to modify our theory somehow. Now, what's a logical thing to do if we want to improve our theory's ability to account for these facts? Well, remember that we got this far, which was quite far, by making one assumption, which is that people are risk neutral. So a logical thing to do then is to get rid of that assumption. And let's do that now. I'm just going to save this, just in case. So now let's get rid of that assumption and assume now that people as we know in reality, that people, instead of being risk neutral, are risk averse. How is that going to help? Well, let me write down the equation we had before. IM was just the average expected short-term rates until maturity. That's what we had before, right? But it doesn't explain the fact that the yield curve usually slopes up, or as Marshall put it, that long-term rates tend to be higher than short-term rates. Now, we were looking at how interest rates are determined, and you may remember that when something tends to have a higher interest rate than something else, it means that from the lender's perspective, there's something bad about the thing with the high interest rate. And do you remember, going back a couple of weeks, I think, anything that we may have discussed about long-term bonds that means that they're less desirable in some sense than short-term bonds. So you may remember that one of the exercises we did was that we looked at what happens to the prices of bonds if interest rates change. And as Sophia points out, indeed, what we found was that the prices of long-term bonds are much more sensitive to any such changes in interest rates in particular. And that means that long-term bonds are riskier. So all we need to do to actually improve this theory is to add to this the idea that people don't like risk. Long-term bonds are riskier, and therefore, in addition to the average expected short-term interest rates until maturity, we could add a risk premium that increases with M. So let's do some examples here. So let's say that the risk premium is that for each extra year of that you have to hold the bond, we need an extra 1% to compensate for interest rate risk. And now we need two things. One, we need to know what the risk premium is. I just told you what it is. The other thing is we need an expected path for short-term interest rates. Right. So let's give a path. Let's make things simple. And suppose we think interest rates, short-term interest rates, will be 10% forever. If we thought that makes life simple, then our short-term rates, I1, according to our theory, is 10%, right? What's I2? I2 is going to have two parts. One is that it's the average of the expected short-term rates this year and next year. So this year it's 10, next year it's also 10 in this simple environment. We divide by 2 to get the average. But there's this additional component, which is I don't like waiting because I'm exposed to interest rate risk. So, or rather, I don't like long-term bonds because they expose me to interest rate risk. And how much is that risk, that premium? It says for each year we need an extra 1%. So I have to add 1% here to compensate for the fact that it's a 2-year bond, and then I get, well, this average is 10, and then this adds 1, you get 11. So even though expected interest rates are constant, we still have an upward sloping yield curve because of this risk premium. See, it's gone from 10 to 11. And I guess, why don't we do I3 as well? I3 is the average of the interest rate the 1-year rate now, the 1-year rate we expect next year, and the 1-year rate we expect the year afterwards. So to get the average, we divide by 3. And now, however, there's also a risk premium, which in this case, since the way we've written it, each year you need an extra 1%. So if I'm waiting one additional year, we have this 1% here. Here we're waiting 2 additional years, and so it would not be 1%, it would be 2. And the average of this is 10 plus 2 is 12%. So you see, this way, even without expected interest rates rising, we can get an upward sloping yield curve. And the upward slope, in this case, reflects how risk-averse people are, or how people feel about interest rate risk. Okay? Any questions, thoughts, doubts? Of course, that doesn't mean that, once again, that these yield curves will always necessarily slope up. So to see that, let's do the following. Suppose interest rates are 10% right now. Oops, sorry again. They are 10% right now, but are expected to decline by 2% each year. Okay, let's look at this one now. This remains the same, right? The interest rate on the 1-year bond right now is just 10%. That's what this means. What about this 2-year bond? The 2-year bond is the average of the interest rate today and what we expect the interest rate to be tomorrow. The interest rate today is 10, but we expect the interest rate tomorrow to be, remember, it's expected to decline by 2% each year. So we would expect next year to be actually 8. So the average of 10 and 8 is 9, and then you add 1%, you get 10. Moving along, I3 is the average of the short-term rate now, which is 10. The expected interest rate next year, which again is expected to decline by 2%, which is 8. And the expected 1-year rate a year further out. In this example, that means interest rates are expected to drop for reason even further to 6. And the average of these things is 10 plus 8 plus 6 is divided by 3, well, it's 24, divided by 3 is 8, plus our risk premium, 8 plus 2 is 10. So in this case, we have a yield curve that doesn't slope up. It's actually flat, right? 10%, 10%, 10%. But the reason it's flat is because we have the risk premium, but in addition, because people expect short-term rates to decline, and in fact to decline quite steeply here, that's pushing in the other direction. So you have one force that makes it slope up. If expected rates are going down, then that would tend to make the yield curve slope down. In this case, with the numbers I put there, they just happen to offset each other, and so you get a flat yield curve. All right? So this adding this risk premium means that now we can explain why yield curves usually slope up. It's because of the risk premium, but they don't always, because if interest rates are expected to decline very steeply, that might make it invert. Any questions, comments, doubts? 4, no. Great. So now with this addition, we're able to explain what yield curves do in general and why it is they have the shape that they do. And we can also, another thing that we can do is go back to our, what did I call it? Yield curve worksheets. And now we can see what kinds of things people must have expected in each of these years. For example, let's take 2006 or 2007, where the yield curves are very flat, or even downward sloping, depending on which part you're looking at. What must have people thought in that year? Well, if a yield curve was flat, it means they expected interest rates to go down in future years. And if you look, were they right? Actually, sorry, this is the wrong picture to see if they are right. If they are right, we would need to look at what happened in 2008, 2009. Well, here it is. So in 2006, 2007, the yield curve is flat or maybe even downward sloping. As discussed, that means they must have expected interest rates to be declining so sharply that it would offset their risk premium. And what do we observe in 2008, 2009, 2010? Spot on, the interest rates declined. So these bond market people must know what they're doing, at least broadly. Here's another thing. If you knew what is the average short-term interest rate, then you could also make an additional statement. What if I told you that the average short-term interest rate is 3%? What that tells you, which could be useful, is that these curves down here, especially 2009, 2010, they're unusually steep, right? So they're unusually steep. It means that their slope contains or is influenced by two factors. One is the risk premium. But if this curve is steeper than usual, it means that there must be a second influence making it steep. And what could that be? Well, interest rates are expected to increase. So that's how you can get that these curves, when they slope up unusually fast, it tends to be when the interest rates, the short-term rates, are very low. And of course, they're expected to return to the usual level. So interest rates are expected to increase. And finally, this may suggest to us why it is that an inverted yield curve tells us that there may be a recession on the way. If the yield curve is inverted, what were we just discussing? It means that people must expect interest rates to go down in the future, and actually to go down quite sharply. When do interest rates go down? Interest rates go down if there is going to be very low inflation, or rather, if it's expected that there will be very low inflation, or if we're entering a recession. Remember, interest rates rise with the expansions and fall with contractions. And of course, interest rates also decline when the Fed cuts interest rates. But when does the Fed cut interest rates? In recessions. So now you see this whole thing should be tied together now. The yield curve is flat only, or it's downward sloping only when you expect interest rates to decline so sharply that it offsets the fact that there's a risk premium. And when do interest rates decline sharply? In recessions. So this worksheet, what it does is it's set up as exercises, but it's walking you through the kind of logic that we just went through. So given the shape of this curve, what must it be that people expected to happen? And then by looking at future curves, you can see, well, did reality turn out the way that they expected? Generally, it seems that in my experience, so you can make good forecasts by looking at yield curves. And then there are also a couple of other questions here if you want some practice. Down here it's saying, suppose you know what the risk premium is. It's some number A, and then if you know what that is and you know what the expected interest rates are, you can figure out what the yield curve must look like. Okay? And we haven't talked about what is going on with the yield curve today. Remember, the yield curve today is way down here. Figuring that out is worth a pretty good debate. It's kind of a puzzle to some extent, but an interesting one. Any questions, comments, thoughts about all this? About yield curves and the theories behind them? Well, if not, then why don't we move through to our usual exit quiz. Roll in. Get ready. First question, true or false? Bonds of different maturity are perfect substitutes. Is that true? Or is it false? Very good. You all got it right. Next. Usually the yield curve does what? Slope up, slope down. Is it flat or is it irregular? Very good. Good job. Next. When the yield curve slopes down, usually what? Short-term rates are high, stock prices are high, stock prices are low, short rates are low. Which one is it? Very good. Marshall is in the lead. When interest rates decline, all maturities tend to decline together. Is that true or false? It's true. Remember, the yield curve tends to move up and down as one. Ezra is first now. Which yield curve is most likely for an economy that's about to recover from a recession? Is it the green line, which is sloping upwards and steep? The blue line that's sloping down? The red line that's flattish? Or the yellow line that's got a gentle upward slope? One more person thinking carefully. Okay, ran out of time. 6 of you got that right, good job. And finally, why might interest rates on long-term bonds be usually higher than the short-term bonds? Is it because people love to buy bonds? Do bonds have higher interest rate risk? What is the reason? And this is a picture of a variety of bonds. Very good, most of you got it right. And now let's see our podium. Third place is Sophia, good job. Second place is Marshall. And our winner today is Ezra. Good job, Ezra. All right, so Ezra, what would you like to do to me today? What's your favorite Snapchat filter?
I think if there's a dog option, that would be good.
A dog. Let's see. Okay. Let's try this one. That's strange. Yeah, I would have thought the dog would give you a lot of options. Let me try puppy. Okay, this is me with puppy eyes. Let's try this one. Okay, there we go. Now I'm a dog. This is perfect. Excellent choice. So thanks for coming and thanks for playing along. I hope you had a useful class. If you have any questions, feel free to write to me. I think we don't have class next Monday, so we won't be meeting until Wednesday. So take care and see you then. Thank you, everyone. Take care.